And so we can see a dissipation of wealth through consumer spending. But, all that's going to do is widen the wealth gap because the people that are invested are going to be basically capitalizing the fact that all these people are spending all this money. And then the other side of the coin is everyone's so bought into passive right now and everyone has very, very concentrated portfolios because of it. So things roll over and go down. We're going to see a lot of people really, really get burnt.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we're midway through the month. We just got the producer price numbers and everything is looking great. So I guess all your worries about the economy, credit, bankruptcies, defaults, it's all been solved. Well, here to discuss is our good friend, Eddy Gifford. Eddy, welcome back. So we should all breathe a sigh of relief, huh?
Well, it's certainly seen that way. It's all in how they present the data. Of course, when you look at PPI, it fell 0.1%, and it was only 1% up over a 12-month period. So, that's obviously below the 2% target. But then when you look at CPI the day before, it came in hotter than expected. So from a wholesale standpoint, it appears that things are kind of under control. But from an actual consumer demand standpoint, not so much. And I think the issue right now is you have so much consumer demand and it's all on credit, but we're not really punishing credit yet. So unfortunately, I think we're going to hit that wall. And I don't know if it's this year, or if it's after that, whoever the new guy is that gets in. But this is heading towards something that could be really bad. We absolutely need the soft landing, because if we don't, it's not going to be good for anybody.
Uh-huh. All right. So soft landing, are you sure?
Well, we need it. I'm not saying we get it. I think that, I just don't know what reaction we're going to get, because we're in this scenario now where we could be in a commodity super cycle where inflation starts to run away again, which would mean the higher for longer and maybe more increases in rates. And in a situation like that, we see the stock market and bond market probably implode. And then the other scenario is, well, what if things are kind of heading good, but then something breaks under the surface, causing the Fed to really have to loosen the money supply and do a rapid amount of rate cuts, in which scenario we would see bonds rally and we see the stock market go down pretty fast. So, we have these two outliers, which I say are, probably more favorable. I just don't know which one is in more favor right now. And then you have this Goldilocks soft landing. It's oh no, it's right. We're going to get it perfect. And it just doesn't seem that way. And my fear is
that way in real life either, does it?
I've never seen it happen personally. I've been told that it's going to happen thousands of times, but I've never seen anything actually go exactly the way that you want it to go. I mean, we've watched playoff football this weekend. Everyone thought the games were going to go one way, and guess what? They didn't, right? That's kind of what happens in real life. And I think that that's the thing, that when you're so hopeful of something being perfect and ending up exactly the way that it needs to be, it makes the reaction that much worse when it's not. And my biggest fear is is that we end up in a scenario where the Fed actually has to start raising again, because that'll catch everybody off guard, and that will just get real bad real fast.
All right. So anyways, the experts though have called 12 out of the last 3 recessions, right?
Well, that's kind of how it works. The one thing we have on our side is the fact that the inversion, and then and then when the yield curve becomes uninverted, right, and goes back to normal, that's typically the sign, and that's starting to happen right now. And the issue just comes down to the fact that there's so many things that happened over the last 3 years. There's so much money that came into the system. There's so many people out there that still aren't working and are just kind of doing whatever. And then the other people are keeping the unemployment rate down because they have 3 jobs. And so when the three jobs go to one, right, and the debt limit and credit card limit is hit for everybody, and student loan payments are the missing those student loan payments actually start counting against you, which is later this year. Those are the things that add up to kind of a credit crunch, and it's at a whole different scale than it was during the crisis. The great financial crisis was primarily real estate driven. Well, now it's consumer demand driven, which we had all this pent up demand from COVID. And that's not only like for consumers, that's also for businesses where people had to go out there and start businesses because they needed to make money because they weren't allowed to work. And they borrowed a ton of money to do that. And so like all this stuff is snowballing. So yeah, all these experts, I've called for the recession last year, but now they're saying, oh no, there's not going to be a recession. And I would argue the alternative. I would say that this is exactly why the recession is going to happen. And this is exactly why it's going to be deeper than anyone anticipates.
All right. So there's no avoiding this recession. How bad is it going to be?
Well, that just depends on the factors. If we end up in a higher interest rate environment for longer, I think it's going to take a lot longer, right? It'll be kind of more of a slow grind down like 2022 was, except for that might last for like 3 years. On the flip side, if something just breaks, I think it'll be pretty rapid, where we might have a 6 to 9 month just like collapse in the stock market. And then at least it would kind of flush things out and we could kind of get things going again. So I would prefer things to just get flushed out so we can kind of get a fresh start, so to speak. But it doesn't seem like that's happening, because at the end of the day, everybody around the world is beginning to trust the United States less and less and less. And because of that, I think that the demand for higher interest rates on the United States debt is going to occur. And so if more and more people are demanding higher interest rates, that means the interest rates are staying higher. That's going to hurt the American consumer, and that's going to make this a slow grind down. I hope I'm wrong. I would prefer the other side, where we just rip the Band-Aid off, but I don't know if that's how it's going to work this time.
All right. Well, it's worked that way in the past. Does this mean the end of the dollar's primacy, hegemony in the world? Because nobody else's currency is doing too great either.
That's absolutely true. I think the dollar is still the main game. I don't see it like going away in the next 3 years, but I think that there's more and more people and more countries that are open to the dollar not being number one anymore. And so that's an issue. Anytime that you get kind of a challenge or you get uncertainty, that's what can lead to a domino effect. So, maybe things change if we get some different leadership in this country, but right now, it just seems like we're going down this path, and the path doesn't look good, and it makes it hard, especially for me as a certified financial planner. And my job is to be optimistic, right? Like, I'm supposed to believe that asset prices are going to be higher 10, 15, 20 years from now, because at the end of the day, like, that's why I have a job. We're going to grow your wealth, and we're having to look at like a lot more active and even tactical investment strategies. We're having to look at more alternatives, leaning more into like things like gold and finding alternatives to bonds potentially, since that flight to safety didn't work in 2022. And so we're just having to find a lot more ways to make money if we end up in like another lost decade type scenario, but we don't have the traditional risk on relationship. So it makes it tough, but you just stay nimble, you be disciplined, and you continue to attack, from a standpoint of take chances, cut your losses, and take profits on the way up, so that if we are in a trade bound market, at least we end up ahead than what the passive flows will do.
Right. So you got to be very, very careful then, is what you're saying, because you don't know how this thing's going to turn out.
Yeah, very, very careful. I mean, you could make the argument that if you're 20 years old, like you can afford to just continue to dollar cost average in. But if you're 50 years old and you're thinking of retiring in the next 15 years, What you can't have is a lost decade where you lose half your money twice, like people did from 2000 2010, and then you end up having to work an extra 10 years that you weren't anticipating. So you start getting a little bit closer, and you really need to be careful because you just can't afford to make a mistake. And on the other side, the 20-something, you don't have to make a mistake. I mean, you can, unfortunately, as it's been my experience that a lot of the 20s and 30s, including myself, when I was that age, we like to learn things the hard way, but you don't have to. There are people out there that can help, and we believe that we are one of those people.
All right, so this is a real conundrum for this. I guess it's really the tail end of the baby boomers and Gen X coming up, right?
Yeah, I mean, we have this huge transfer of wealth that's right around the corner with the boomers and the next generation, and a lot of the next generation just isn't as good with their money, and there's a little bit more of a now, I want it now type attitude, and so we can see a dissipation of wealth through consumer spending. But, all that's going to do is widen the wealth gap because the people that are invested are going to be basically capitalizing the fact that all these people are spending all this money. And then the other side of the coin is everyone's so bought into passive right now and everyone has very, very concentrated portfolios because of it. So things roll over and go down. We're going to see a lot of people really, really get burnt. And then, it makes it tough because it's like, okay, well, that's okay. Let's get back in. And nobody wants to. So good old behavioral economics, we've seen it happen time and time and time again. And my fear is that's a little bit worse this time because the next generation is just not as educated as the previous one was.
All right. Well, it's lots of interesting things ahead. So again, what do we do?
Well, I think at the end of the day, right now, if we're looking like big picture macro, it's like, yeah, it looks gloomy. But if we're looking like short term, next 6 months, next 9 months, maybe not so much. Generally speaking, in election year, they try to do whatever they can to make sure that nothing happens until after the fact, right? So we need to get the election over with before we can let things collapse, I think is kind of like the attitude of most politicians because they don't want to be able to have either side blame it on the other side. So I think that if we're looking over the next 3, 6, 9 months, we still have to lean in. Earnings season is starting. We're going to see a ramp up in volatility. We are due for a pullback in the market. So right now might be a good time to kind of dollar cost average in. But as far as your portfolio itself, you have to be disciplined and you have to have a predetermined reason to get into something and a predetermined reason to get out of it. It's not just good enough to buy anymore. We have to have a reason to get out, whether that's a profit, whether that's a stop, whether that's a big picture relationship. But there needs to be a reason because right now it's going to be more important to protect your wealth when things get bad. But at the same time, the everyday investor just can't handle that FOMO and they just want to ride the wave up. So, my job is to kind of have a balance of, okay, well, let's try to give you as much of that as possible. But then it's also protect you if things get really, really bad, really, really fast. So I think discipline, take the emotion out of it and don't be afraid to be nimble. And at the end of the day, like if you're scared, there are things like cash, there are things like gold that can serve as a good hedge against uncertainty. And so, have some of that in your portfolio.
All right. Well, that presents a lot of challenges, but with challenges often come opportunities. So it's time to start figuring this out now. Eddy, where do we find you at these days?
Yeah, so easiest thing is it's tactivewealth.com/Eddy-Gifford. That's my website. And then once you get there, there's all my contact information and everything. As far as contact information in general, easiest way to get a hold of me is email. That's Eddy with a Y, .Gifford@tactivewealth.com. And, we're just looking to help anyone who's a little bit unsure or uncertain about what's going on out there. And I think there's a lot of them out there right now. So we're here to help.
All right. Appreciate that. Hey, if you've got a question for Eddy and myself, shoot me an email, kl@kerrylutz.com. And of course, a link to Eddy's site will be in the show notes to this interview on financialsurvivalnetwork.com. Make sure you sign up for your free newsletter. Eddy, always a pleasure. We'll talk to you again soon.
Appreciate it. Thank you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network. Now, more than ever.